Hello, everyone. Welcome back to Signal or Noise. This is episode 46. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, we had a lot of fun on the last episode. There was a lot of value. People really appreciated the price of admission, so I figured let's do another timeless episode here. We're still in the midst of this correction. So what should investors be thinking about? We're going to talk today about making a checklist for corrections. And before we begin with the checklist, let's just give an update where we are in terms of the S&P 500's decline here. You could see from peak to trough, it went down about 10.5%. We've bounced back a little bit. This is going to go back and forth. This could deepen. It could totally recover. Nobody knows. This is the 30th correction greater than 5% since the March 2009 low. There's going to be many more of these. And what you shouldn't be obviously doing during a correction is making an emotional decision saying, sell everything, get out of the market. I can't take the pain anymore. So instead of doing that, what should you be thinking about? We're going to give you 5 things to think about. This is the checklist for every correction, and there's going to be many more corrections if you're a long-term investor. So let's begin with number 1 on the checklist. Step away from the screen. We're going to go to this quote from Jack Bogle here. Don't do something, just stand there. Now, Peter, that's a great saying. You and I believe that. But in practice, for most people, it's hard to not do something, right? When there's pain going on in your portfolio, when you have all of these fear-inducing headlines, it's very difficult in practice to do what St. Jack is advising here, isn't it?
I think it's just so anti-American. Like if you've got $100,000 or $100 million in your portfolio, I mean, you've done some things very, very well. So you've been really good at your job. You've been really good at saving. You've been very disciplined, or you've built a business. You've done something, right? And so you get there by your experience is there are rewards for people who take action, and there are people that do better than other people. And then we go watch sports and we see the same thing. Like if you work harder, if you make this move, you make halftime adjustments, you're going to win the game. But with investing, it's the opposite, right? The person who's got the patience, the person that's got the intestinal fortitude, the person who can get through the corrections without making changes because we know when you start to make strategic changes in a correction or a bear market, we know factually that the odds dramatically increase that you're going to underperform. So this is it's the opposite of everything that we see with our work and our school and when we watch sports. It's the opposite of all of that, in that we need to stick with the plan. We need to stay patient. And as Bogle said, don't do something, just stand there. You get rewarded for sludging through the corrections. Now, you could say, well, isn't there some adjustment we can make? There are things where, that you and I can talk about, like rebalancing, tax harvesting, but that's different than let's go to cash and wait things out. That's a mistake the overwhelming majority of the time. And because corrections happen every year or two, if you try to time these, 10, 20, 30, 50 over your lifetime, you're going to be wrong the majority of the time. It's going to cause harm.
Right. And so the sense is that action, if you're going to take an action, it's likely going to be based on fear. And that's why it's problematic, right? A lot of people, when they're going through these types of declines, they're not thinking about the eventual recovery. They're thinking it's only going to get worse. It's only going to get worse. And I'm showing you here a chart of US mutual fund and ETF flows. And you can see the last 3 bear markets, what were investors doing in mass? They weren't just sitting there. They were selling. And the worst of these declines, of course, occurred in March 2020, where we saw record outflows in terms of US equities. So here's a list that I put together in terms of things. If you're feeling the urge to sell, Peter, step away from that screen. Here's a few things I think would be better to do during that period of time. And then you could come back to the market, hopefully with a better state of mind. Go for a walk, listen to music, read a book, watch a movie, or talk to a calming voice. Peter, you're one of those calming voices. You probably had these conversations many times in the past few weeks. What do you say to people when they're in that state of distress and they're saying, my portfolio is down, I think it's going to get worse because of X, Y, and Z? How do you offer that calm to them to say it's going to be okay, stick with that long-term plan?
I mean, first, the feelings are legitimate because you know what? It can get worse. It can get worse. So when we have a correction, sometimes that correction persists. It goes on longer than normal. Sometimes it's deeper than normal. A minority of them turn into bear markets, which are 20% drops or more. So you have to acknowledge the reality that yes, it could. But for at least for our clients at creative planning, we've they have a plan. So we know that in the short run, we don't have any money in equities that they need over that short run, right? So we can assure them that, hey, all of the money you need for this period of time, we have that covered, right? And then now let's look at if it does get worse, what does history tell us the recovery time is? And the recovery time is much, much shorter than the period of time when we would need to access that money anyway. So there's, it takes a little bit longer than that. But the first thing is to just acknowledge that it actually can get worse. Now I've got to get back to this list that you've got, Charlie. So looking at your list, and you've got listen to music on here. I'm a big music fan. But what kind of music are you recommending here? If you're freaking out about the market, should we go, are you saying like go listen to Rage Against the Machine and get some of the steam off your chest, or is this more like classical music? Like what are you playing?
Probably not. I just think just some type of distraction. So whatever your
Right.
favorite
Okay.
band is,
Just
you
switch
get your
gears,
mindset,
basically. All right.
yeah, in a more positive state of mind. Obviously, exercising can do that. All of these things can reduce stress, right?
Yeah.
Just getting away from the idea that the market is everything. Is like what's going on today is going to be the case forever, and we just don't make good decisions, Peter, when we have this rising level of fear and anxiety. And so usually when you sleep on it, you
Yeah.
give it a night, you come back and you have just a better perspective. So that,
Yeah.
and you wouldn't make that same decision is what I'm saying, that when you have that urge to sell.
I think if you're, let's say you're 40 years old, you have to ask yourself, like, look, a correction happens every 12, 15 months. If am I going to freak out, not just now, but the next 40, 45 more times throughout my life? Or am I not going to, right? You have to like look at like how often this is going to happen for the rest of your life. And that can help you maybe put in perspective just how emotionally involved you want to get this specific time.
Absolutely. Which brings us to the second point in the checklist, which is find your true risk tolerance. Because if you're stressing out about a 10% decline, which, as you said, happens pretty much every other year in the US equity market, then perhaps your risk tolerance is actually lower than you think it is. And the problem, Peter, I see with risk tolerance, there's many problems, but often we assess it during periods of calm. And if, let's say, you came into the market in 2024 and that was your first experience to the US equity market, you probably thought, wow, this is pretty easy. It's pretty normal. 57 all time highs, averaging a little more than one per week. We had very low volatility during the year. The few pullbacks we had were very brief and they quickly recovered to new all time highs. So if you took one of these questionnaires, I just pulled two of the questionnaires from Schwab and Vanguard asking, well, what would you do if in a 3 month period the stock market went down 25% or 30%? As we know, it's done at times in the past. And would you sell all your shares, some of your shares, do nothing, or buy more? A lot of people will be like, yeah, I'd either do nothing or buy more shares. But realistically, they don't know that yet until they're actually in that period of time. I think our risk tolerance is not a static measure. When things are going very well and the news is all positive, our risk tolerance actually goes up. But when things are bad and the news is bad, our risk tolerance tends to go down. Does that make sense to you? Sense to you? And how do you think about these types of questionnaires? Do you think you can quantify risk tolerance just based on, let's say, 10 questions for
Yeah,
people to answer?
definitely not. I think regulators like to see these questionnaires, and so we, all the advisors have to do them. But it's a
Yep.
great example of where regulators cause more harm than good. I think that there's no way, with this specific thing, because it implies that we really can't measure someone's risk tolerance from 10 questions. And your point, Charlie, the answer is, of course, you cannot. Like if you look at a piece of paper and it says, "Hey, your account can go down 10% or up 10% versus 20 and 20," everyone's looking at that higher return. The number on the piece of paper is very different than watching a $3 million account become $2 million in 6 weeks. Right? Going,
Yeah.
I know my clients' risk tolerance from going through a bear market with them. That's when you find out. There's some people that they're not even paying attention. There are some people that are paying attention but completely unfazed. There's some people that get a little nervous, and there's some people that it truly becomes an emotional crisis for them, right? And so, those are the ways to really understand your risk tolerance. Is when you are going through a real correction or bear market, look at your behaviors, look at your emotions. That's your risk tolerance. That's much more valuable than a questionnaire.
Right. So if you've been an investor for 10, 15 years, Peter, go back to those periods of time, I would say, and try to think about how you felt. Look at your actions. Were you making changes in your portfolio? And we've had these examples here since the 2009 low. We had a 2011 correction that was bigger than 20%, 2018, 20%, actually, with a similar reason to today, being blamed on tariffs and trade wars. 2020, 35% in the S&P 500, and 2022 we had another 20% decline in the S&P 500. And what we're seeing, Peter, is that when you're living in the midst of it, it's very different than theoretically what would you do with a 20 or 30% decline. When you're in the midst of that decline, well, that's going to tell you your actual risk tolerance. If you're saying during these declines, I'm fine. I know long term the market's going to come back. I don't feel like making any changes. And maybe even I'm thinking about rebalancing or buying more stock, or if I have cash on the sidelines. We're going to talk about that in a little bit. But to me, Peter, it comes down to breaking it down in terms of dollars for investors. And we often talk about percentages. People don't think in terms of percentages,
No.
they think in terms of dollars. And there's a big difference, right, Peter? If when you're starting out, you have, let's say, $10,000 in your portfolio, a 50% decline there, $5,000. Yeah, that's hard to stomach, but it's much different than you've built up a portfolio over 20, 30 years. You have $1 million, you're approaching retirement, and now a 50% decline is going to mean 500,000. Emotionally, the two numbers on a percentage basis might be the same, but we don't react the same way when we're dealing with bigger numbers.
No, I think like the thing that matters the least is points. Like when people talk about points on the Dow, and then
Yeah.
the percentages matter more. But both of those put together times 10 don't equal what you just talked about. People are focused on the dollars in their portfolio, particularly the dollar loss off an all time high. Whatever the all time high is, that's the number everyone's focused on, the all time highest the portfolio has ever been. And every dollar off of that, further away you get closer to finding out what your true risk tolerance is.
Yeah, because people are thinking, well, I could have bought this with that money. I
Right.
need this to live off of, and they're translating it naturally. And I think that makes a lot of sense. So if you're an equity investor and you're going to be in the market 30, 40 years, we do see 50% decline. So you have to understand that we saw that in 2000 to 2002. We saw it in 2007 to 2009. No, it's not a frequent occurrence. But if you can't stomach that dollar loss in your portfolio of a 50% decline, then you probably can't be 100% in the equity market, is the way I like to think about it.
Yeah.
So always convert to dollars.
To your point about people saying, "Hey, I could have bought this or that." I had a client last week tell me this correction. I could have bought 12 BMWs with the money I've lost so far. So I reminded him, that he could have bought a dealership with the money that he made, in the previous year. It's all perspective, right? But these corrections, they're normal, but no one's looking at the percentages and the points that people talk about on TV. They're immediately looking at the dollars in their portfolio. No doubt about that.
Yeah, so figure out your true risk tolerance, and as you go along and as you experience these things, you can adjust. It's not a static number, and maybe people's risk tolerance change, Peter, for all different things. They have different life events. They can take more risk at a certain stage of their life, less risk. So it's not a static number whatsoever in a creative plan. That's why we're in constant communication with all of our clients to say, well, has something changed in terms of your situation where now you want to take more risk or less risk? It's a constant evaluation. It's not a set it and forget it plan. Okay, let's go to number 3 in the checklist here. Make sure you're really diversified. And after the last decade coming into this year, Peter, we know there's been a lot of questions. Well, do I really need to be diversified? Can I just be in large cap growth stocks, which have done the best over the last decade, annualizing at 16.8%? This is U.S. large cap growth, in the S&P 500. We know has done much better than its historical average at 13%, and everything else trailing off from there. And if you look at within that growth category, we know, Peter, that's being driven by primarily, not only, but primarily these seven stocks known as the Magnificent Seven: NVIDIA, Tesla, Amazon, Microsoft, Apple, Meta, and Google, all annualizing at over 20% per year over the last 10 years. Highly unusual, and even more unusual because a lot of these names were the biggest companies 10 years ago, and they've remained in that category. So coming into the year, there was a lot of pushback, of course, in terms of diversification. I should just be concentrated in these names. Now, the risk, of course, Peter, is that you have a correction and you have a bear market where these names go down much more. So the risk of putting everything in one basket is that that will be the worst performing asset class for a period of time, or for a long period of time going forward. Now, we're only at the end of March here, but I just want to point out, so far this year, that diversification principle is back in play because of what we saw during this correction. We actually saw 6 out of the 7 names in the Magnificent Seven underperforming during this correction. This is as of the low in so far the low in March 13th. So we're seeing much bigger declines in these names, which is not to be unexpected because of the run up beforehand. And we're actually seeing, Peter, this is the most remarkable thing, not really a pullback at all if you look outside of the US. So the stocks that have done the worst over the last decade are actually doing the best this year. You got European equities up close to 12%. This is on the date of the low. It's actually higher as of today. International outperforming, value outperforming, and bonds actually doing their job up a few percent. So how do you think about diversification in general? And is this playing out this year in a way to illustrate to an investor, once again, why you diversify?
Well, I mean, it's early, right? But it is interesting at the turn of the decade. I mean, literally 5 years ago, Vanguard, BlackRock, Goldman Sachs could only agree on one thing, that they expected international stocks to do better than US over the next decade. And of course, that has not been the case, like not even remotely close. But here is what could be a turn. We've had some false starts before, but it is interesting. You and I have been fielding questions recently about people saying, "Hey, why don't I have more international stocks?" Talk about, a total change in questioning, right? For at least the last couple of years, there's been, why do I have any international stocks at all? There's a reason that very, very wealthy people and big institutions invest their money globally. You just shouldn't have all your eggs in one basket. Hershey's in the US, Nestle's overseas. We could do this across all kinds of industries, and to diversify country risk and regulatory risk and currency risk and all these other things, it makes sense to have the eggs spread out in other baskets. Having said that, you can't get away from the fact that the US is the heart of the global economy. Everything begins and ends in the United States, and a lot of the earnings of the S&P 500 companies come from overseas. So if you were going to have one country that you have an overweighting to, the only one that you could logically make an investment case for is the United States. So I am a believer in a very significant weighting to the United States, but not all the eggs in one basket ever at any point in time.
Yeah, and if you just look, if you're just a purely passive investor and you're saying, I'm just investing based on market cap, you would be overweight the US versus
Mhm.
everything else, because coming into the year is about 65% of the global market cap. But having that other piece of the pie in there, the reason why you do that, the reason why you diversify, is so you can hopefully stick with the drawdowns and maintain your portfolio when there's something in there that's not performing as well as the others. When there's a bigger decline in one of those aspects, it reduces that risk, right, Peter? There's always going to be one of these areas that's outperforming and underperforming. We don't know in advance which it's going to be, and that's why you need to diversify. It's really a risk management tool to help you stick with a portfolio over time. Okay, let's go to number 4. People want to take action, Peter, and I can relate to that. during big declines. They don't just want to sit there. And here's one thing that we're saying, yeah, you can look at actually doing to rebalance, to manage risk and buy low, sell high. So first, let's talk about the example of 2020 and what a 60-40 portfolio would have looked like here at the March lows in 2020, when a lot of people were doing the opposite of what we're going to suggest. They were getting out of the stock market, record outflows. You can see here on March 23rd, 2020, the S&P 500 is down over 30% on the year. You have bonds up about 1% in the US. And if you look at a 60-40 portfolio coming into the year at 60% stocks, 40% bonds, well, by March 23rd, Peter, because of that decline, now you're at 50.7% stocks, 49.3% bonds. And had you said at that point in time, well, this is an opportunity to rebalance, I don't know if this decline is going to go to 40, 50, 60%, but I know that in the long run, stocks should outperform bonds. And so let's get back to that 60-40 portfolio. If you rebalance back to that 60-40, 60% stocks, 40% bonds on March 23rd, well, you benefited from this enormous recovery I'm showing you here. March 23rd through the end of the year, S&P 500 goes up 70%, one of the biggest comebacks in history. The bond market continues to advance, goes up 6%. And what we see at the end of the day here, Peter, is if you hadn't rebalanced, you would still have been up on the year about 14.2% for that 60-40 portfolio. But with that rebalancing, you're actually bumping that up to 19.1%. Now, this is the showing like perfect timing in terms of that rebalances, which is not reasonable. But this is something creative planning was actually doing in March of 2020, not making a prediction on the short term, but saying this is an opportunity for long-term investors. How do you think about rebalancing for investors during corrections?
Yeah, I think if the correction's severe, swift, you're coming off the allocation that you started with, rebalancing is fantastic. Some people never rebalance, your portfolio will get totally out of whack. Some people do it annually or quarterly. I don't like that because you miss the opportunities. Like if you look at the 0809 crisis, the bottom was March 9. If you waited till the end of the quarter, you missed a very significant run up, a 30% run up. Same thing here, right? And if we go back to, say, for example, COVID or recent examples, you really want to rebalance when the opportunity is there. And most mild corrections don't present that opportunity because the portfolio usually is overweight stocks, and stocks are usually outperforming bonds. And so, if anything, there's usually more stocks allocated to the portfolio than was the original target. So sometimes corrections just bring you back to the normal allocation, which is fine. But if you get those opportunities that happen every couple of years where the stocks drop very significantly, very quickly, and the allocation is out of whack, that is the time to rebalance and make the move, sell bonds, buy stocks. You will come out, assuming a market recovery, which has happened every time in history, you will come out ahead 100% of the time. This is one of the few times we can say that. But you have to take advantage when that opportunity arises, which is not at the end of a quarter or end of a year. It's going to happen whenever it happens.
Right. And the opposite of this, where I say you also rebalance to manage risk, and we talked about this a few times last year, when the stock markets had an abnormal run higher, we had two straight 25% years in 2023, 2024. Well, now your portfolio is likely, as you said, much higher percentage of equity. That's time. That's the perfect time to think about, well, what can I stomach here in terms of a
Right.
drawdown? And if your risk tolerance hasn't changed, but you're taking a lot more risk, well, that's what you do in terms of selling stock and buying bonds. That's not going to likely enhance long-term returns. That's all about risk management. But here we're talking about the opposite during corrections. Well, that gives you the opportunity then to feel better. Okay, I have all of this dry powder. I have this in a lower returning asset class. Well, why not put some of this to work if I have 10, 20, 30 years as an investor? Which brings us to number 5 here, view declines as long-term opportunities. And Peter, this is, I think, an important point that's lost on a lot of investors when they first invest in the stock market. This idea that you're just going to be experiencing gains, throw that out the window. 92% of the time, Peter, the S&P 500 since 1950 is actually in a drawdown below an all-time high. So you were talking earlier, people anchor to that high point in their portfolio will expect that a lot of the time that's going to be the case. There's going to be some type of drawdown, and the drawdown that we've seen so far this year, 10% is nothing on a historical basis. We've seen intra-year drawdowns of roughly 13 to 14% on average going back the last 100 years.
Yeah, I mean, this is the norm. The market hits an all-time high about every once 19 or 20 days, which means the overwhelming majority of the time it's off the all-time high. People can live with that day to day being off of it. It's these corrections where they're off of it by tens of thousands or hundreds of thousands or millions of dollars that it starts to get to them a little bit. But to your point, if you just understand that the norm is to be off the highs, obviously it becomes easier to deal with.
So most of the time, Peter, we know these 10% corrections will stop there. Like it's like there's a higher probability of this going back to an all-time high this year than it deepening to a 20% or 30% drawdown. That doesn't mean it can't happen, but your base case during any type of drawdown should actually be a recovery, and you shouldn't be thinking about the short term, you should be thinking about the long term. So the question I often get is, just looking at the data, does a decline mean that you should expect more declines going forward, which obviously is the fear? And the answer to that is no. We're going to see these declines every year, different magnitudes. We're going to see bear market every 4 years on average. But your expectation once you're in that, Peter, should be a recovery, because that's what the data has shown historically over 1 year, 3 year, 5 year, 10 year, 15 year, 20 year. Regardless of the drawdown amount, we see positive forward returns. And what I want people to focus on is not that 1 year period. I know that's what you're thinking about. How's the market going to do over the next year? Nobody knows that. If you're in this for 15, 20 years, what you'll notice here is the bigger the drawdown, the bigger the recovery. And that's an incredible thing for investors to understand, that with every tick lower, if you're a long-term investor, your return expectations actually go up.
Yeah, I think what one of the things that I've observed in bear markets when things are really severe is people go, well, gosh, at 6%, at 10%, 11%, it's going to take me 5 years or 6 years to get back to where I was. But as your chart points out, Charlie, that's not really how it works. It's like a rubber band, right? If we the more severe the pullback, generally the more rapid the recovery. That's generally how it works. And usually because if something really severe happens, it creates this total contraction of like, oh my God, there's a blizzard. I'm not going outside till the blizzard's gone. So think about 9/11. Think about COVID. Once the blizzard's gone, everyone goes back outside, you get the very quick recovery. So, for example, if we have a correction and the correction is 90% related to tariffs and it causes a 15% drop and then the tariffs gets resolved, you can expect a quick recovery. Now, we're not sure that's what's happening now. The market's dynamic. There's all kinds of stuff happening besides tariffs. But generally speaking, the steeper the drop, the quicker the drop, the faster the recovery.
Yeah, and there's a few reasons for that. One, people are overreacting, usually on the downside, because there's negative news going on. And that's what we do as human beings. We overreact. And two, just mathematically, stocks are becoming cheaper when they go down. And so I always find it crazy that sentiment gets more bearish. Have you seen some of the polls lately in terms of consumer sentiment and sentiment for the stock market? It's plummeted, right? So it was very high entering the year, and now we have this correction, and people are all of a sudden feeling bad. They should be feeling better than they did last month because stock prices are lower, and we have the data to support that. There's almost a linear correlation here between lower the valuations, the higher the future returns. This doesn't tell you anything about the short term, but in the long run, that's why you're getting this premium from big drawdowns. If you think about March 2009, obviously, perfect example, stock market went down 57%. And the future returns from there were phenomenal because stocks were cheaper. So we don't know how deep this is going to be. 10% is nothing. I'm not saying that stocks in the US are all of a sudden this crazy cheap valuation. That isn't the case. But what you can say, Peter, is they're better than they were when they were at record highs just a few weeks ago. Okay, so here's the checklist for corrections, not just this correction, but any correction. Step away from the screen. Find your true risk tolerance. Make sure you're really diversified, rebalance to manage risk, and buy low, sell high, and view declines as long-term opportunities. This is a checklist that you can use going forward. And remember the wise words from Abe Lincoln. I know it feels like this correction, whenever you're watching this, is going to last forever, but it won't. As he said, this too shall pass. If you're thinking about your portfolio, worried about the correction, reach out to us today at Creative Planning, creativeplanning.com/Charlie. Get a free wealth path analysis. Make sure you're on the right path to financial independence. At Creative Planning, we're in all 50 states and we're abroad as well. So we likely have a location right near you, over 350 billion in assets under management advisement. We're here to help. Reach out today, creativeplanning.com/Charlie. Thanks everyone for joining us today on Signal or Noise. If you're watching this on YouTube, hit that subscribe button. Leave us a comment. I read all the comments, try to reply to as many as possible. And Peter and I will see you on the next episode of Signal or Noise.